Hello guys, myself Nitin B. I am currently pursuing MBA at Sri Venkateswara College of Bangalore. Today I will explain about five porters of force model. Porter's five force model. The Porter's five force model is framework for analyzing the competitive landscape of the industry. It helps to determine the attractiveness of the industry by examining the five forces that influence competitions. Next, we will move on the threat of new entrants. First one, barrier to entry, economic scale, network effects, switching costs. First one, barrier to entry. High entry barriers can deter new entrants, including high capital requirements and government regulations and barred brand loyalties. Next, economic of scale. Existing player may benefit from economic of scale, making it difficult for new entrants to compete to price. Network effects. Industries with strong network effects, where values increases with the number of users, can be difficult for newcomers to pretend. Next, switching cost. High switching cost for the customer can discover new entrants, as customer may be reflected to switch from established brands. Next, we will move on the bargaining power of suppliers, concentrated suppliers, unique products or services, switching costs for buyers. Concentrated suppliers. When suppliers are concentrated, they have greater bargaining power, potentially forcing higher price for better terms. Unique product or services. Suppliers offering unique or differentiate products or services have more leverages, as buyer have fewer alternatives. Switching costs for buyers. High switching costs for buyers to change suppliers can strengthen the bargaining power of suppliers. This is the bargaining power of suppliers. Next, we will move on the bargaining power of buyers. Concentrated buyers and standardized products and low switching costs. Concentrated buyers. When the buyers are concentrated, they have greater bargaining power and can negotiate lower price or better terms. Standardized products. Buyers have more bargaining power when products are standardized, as they have multiple suppliers to choose from the products. Low switching costs. Buyers can easily switch between suppliers when switching costs are low, giving them more power in the negotiation of the prices. This is the bargaining power of buyers. Next, we will move on the thread of substitute products or services. Availability of substitutes, performance of substitutes, switching costs. First one, availability of substitutes. The existence of readily available substitute products or services can limit pricing power and profitability. This is the availability of substitutes. Next, performance of substitute. If substitute products or services offer comparable or better performance at the lower cost of, they can pose a significant threat. This is the performance of a substitute. Next, we will next switching costs. Low switching costs for a customer to adopt substitutes can increase the posed by alternatives. This is a switching cost. Switching means the shifted to one products to another products. This is a switching cost. Next, we will move on the intensity of competitive rivalry. Number of competitors and industry growth rate, fixed cost, exit barriers. Number of competitors. A large number of competitors can lead to intensive rivalry, as companies fight for market share. Industry growth rate. In slow growth industries, rivalry can be phrased as companies complete for limited growth opportunities. Fixed cost. High fixed cost can incentive companies to cut prices or increases production to spread cost. intensifying rivalry. Exit barriers. High exit barriers such as specialized assets or contractual obligations can trap companies in an industry increasing rivalry. This is the intensity of competitive rivalry uh, in the public or any of the competitions. Next we will move on the analyzing the industry attractiveness. These are the attractive of the industries like high threat of new entrants, low threat of new entrants, high bargaining power of suppliers, high low bargaining of power of suppliers, high bargaining of buyers and low bargaining of buyers, high threat of substitute products or services, low threat of substitute products of services, high intensity of competitive rivalry, low intensity of competitive leverage. These are the alternative attractiveness of the industries to analyzing the attractiveness of the customers. Next we will move on the applying for the model to business strategy. Strategic strategic positioning. Companies can use the model of identifying strategic positions that minimizing competitive threats and minimize opportunities. Next, competitive advantage. Understanding the forces help companies develop strategic to create and sustain competitive advantage. Industry analysis. The model provides a framework for analyzing industry dynamics, identifying key threats and anticipated future challenges. Investment decisions. The model can inform investment decisions by evaluating the potential profitability and risk associated with the different industries. This is the applying for model to business strategies to applying the this four strategies to applying for a business model to use the to improve the business and organizations. Next, we will move on the conclusions. The Porter 5 Force model is a valuable tool for understanding industry competition and developing effective business strategies. By analyzing the 5 Force, companies can gain insights into industry attractiveness, potential threats, and opportunities for competitive advantage. This is the conclusion of Porter's 5 model, 5 Force model. Thank you for watching. If you like this video, please give like and subscribe my channel. Thank you.